Hey everyone, this is Richard, and today we're going to be talking about breaking key moving averages, which is a form of distribution. And first of all, what does a trend and what does normal action look like? Well, here we've got Zoom in 2020, which during its strong uptrend from under 100 to ultimately almost 600, it found support at the 50-day here, here, and here. It undercut it slightly, didn't live below it, and found support at the 65 and carried on all the way basically to its intermediate top, and then ultimately cut through those key moving averages and started its longer term basing period. So this is a very normal uptrend here, aided by a very strong market. But this respect for these key moving averages is something we see over and over looking back at great historical winners. So you want to look for institutional support to come in at the 50-day or 10-week. That's a classic point of institutional support. But there's some other key moving averages that we like to use that looking back at those charts of the greatest winners of all time, they often seem to respect these moving averages right here. So here's another example. We've got Livongo also in 2020. And after its consolidation breakout here, it found support at the short-term moving averages, the 21-day and 23 EMA here during this consolidation here. And then ultimately you can see that it breaks through them and closes below it here, finds support at the 50, but at this point it's following the price action of Teladoc, which acquired this stock. So another good example of during a very strong uptrend, the shorter term moving averages will basically hold this longer term move in a very strong stock. So that is Livongo. And moving on, we want to ask ourselves, how do we choose which moving averages to use? So there's kind of three main ways that I look at it. The first is you want to look to the left on the chart and identify very simply what moving average has it respected in the past. Some stocks will like the 21-day, others the 23 EMA, others the 50-day, others will completely ignore the 50-day and instead find support at the 65 EMA. You have to kind of find and determine what the character of the stock you're trading is and use those particular moving averages. So here we've got CELH, found support at the 21-day here and here in the 4s and 5s, and continued on with that pattern basically until it begins its longer term basing period. So that's the first way. The second is to kind of align your moving averages with your time frame. So if you're a longer term holder, you're going to use the 150-day or 200-day because it basically aligns with your time frame better and keeps you in those longer term trends of the stock. And finally, the third way is just to use ones that many leading stocks going back and looking at historical precedents respected. So these ones right here that we use, you can use those. Really, it's finding the ones that suit your needs, your time frame, and your trading style. So that's how to choose which moving average. And moving on, let's talk about normal pullbacks. So not every undercut or approach back towards a moving average is created equal. And you want to know basically how to identify what is normal action versus abnormal action. And here we've got NIO, which is an example of normal action as it pulls back to the 23 EMA, which are really respected during its run. It is basically on lower volume. You can see that right here below the moving average. And every time it does that, it's on declining volume. And this is very constructive. And price action as well is very tight. And it's kind of drifting back in. It's not falling straight down into the moving average. It's drifting slowly in on lower volume. That is the key to a normal pullback, low volume and a drift in versus a sudden drop in just a few days. So that is what a normal pullback looks like. And in terms of abnormal pullbacks, this is an extreme example, but we've got EHang here. And you can see on this day, it basically does a few things wrong. But most notably, it breaks that 23 EMA, which it had been respecting on very high volume. So you can see here, I think this was a 60+% drop in one day. So very extreme on high volume. And you can see it slices right through that key moving average, which it had been respecting during this uptrend. The other things it did wrong was break this base low, as well as failed to break out here. So a couple things went wrong here, and this magnitude of a failure definitely means that there's some liquidation by funds, and that weakness has continued as it dropped from a basically high of around 120 all the way down to the 20s. So not a move you want to be a part of. And when you see a stock doing this, you want to exit as soon as possible as it's completely breaking expectations. So in summary, an abnormal pullback is usually on high volume, usually above average volume, and the velocity of the decline is also a giveaway. So a abnormal pullback might be in 1, 2, or 3 days, falling 10%, 15%, whatever it is between that and the moving average, and basically slicing through it and showing really no respect for that key moving average. And on the other hand, you've got normal pullbacks where you've got basically a drift back into the moving average on lighter volume, usually below average volume, and you're basically letting the moving average catch up by pausing the price increase. So that's the difference between normal pullbacks and abnormal pullbacks. And moving on, let's talk about losing respect for key moving averages, which is another sign of distribution and a potential base incoming. So this is Coop going back to, I believe, around 2017. It's had quite a run here. It's got some nice uptrends, then some basing periods. And you might notice that during its uptrends, it shows nice respect for the 23 EMA as well as the 50 SMA. And then during these bases, it doesn't really seem to respect those lines at all. And it's not until another strong move up and breakout and continuation of the trend that starts to find support at those key moving averages again here and here. Here we've got another base, it loses respect again. Basically the March correction, strong move up, respect for the 23 here, here, 50 here, and then once again, a base building process that's still currently in. So look out for this characteristic. You want your stock to be respecting key moving averages that it has respected in the past. And when a stock finally breaks through that, that could signal the end of the intermediate trend and potentially the start of a base building process. And finally, let's talk about position management and how you might use different time frame moving averages to basically stagger how you exit a position and keep you in for the majority of a trend, like with Peloton in 2020. So here we're going to use the 50 SMA, the 23 EMA, the 10 SMA, and the 200 SMA. And let's say you bought it pretty well. You bought it at this breakout of this consolidation pivot in 2020, or as it moved up, pulled back, and you established your position right here. So from these buy points, you can see it moves up strongly and breaks out of this consolidation. And then here is the first day after this breakout that we close below the 10 SMA. And at this point, you've got a nice profit cushion, and so you have options. And here, if you're a more short-term trader, you might sell 50% of your position and ride the remaining 50% for the longer move. Or if you're mostly focused on intermediate trading, you might only sell 25% and hold 75%. But regardless, the stock recovers, doesn't close below its 23 EMA, and continues on up from there. And another thing to notice here is at this point, the 50 SMA has kind of moved through your cost basis, so you can kind of shift your focus to that key moving average and use that as your kind of a backstop here. So you can really follow a stock throughout its uptrend, especially after a correction, very well using the 50 SMA as your backstop. So it closed below that key moving average. But let's say you do want to sell 25% after it kind of breaks the 23 EMA. So at this point, you sell 25%. So you've got 50% left, and you're using the 50 SMA as your stop. Well, that keeps you in until this gap down here and 2 closes below it. And at this point, you're stopped out. Now, if you're a really longer term trader, you can use the 200 SMA, this purple line. But for me, I like to focus on the shorter term moving averages. It's also important to note that you might want to write some rules on what defines a close below the moving average, because remember, it's all about the area of interest instead of the just line value. So here might not even count as a close below because it barely undercuts that key level. So make sure in your rules that you're very specific and consistent as well, and that you're choosing these moving averages based on your style and time frame. Somebody who's swing trading is not going to be using the 200 SMA, and likely if you're an investor, you don't want to use the 10 simple to get stopped out at 50% of your position. It has to make sense for your own investment style and strategy. Another key point here is, as much as possible during a strong uptrend and bull market, you want to operate on a closing basis when using key moving averages. So here we've got DocuSign in 2020, which broke out of a pseudo cup with handle and basically rode the 10-day all the way from under 100 to over 200. But there were some pretty vicious kind of shakeouts along the way. So here, for instance, it basically went all the way down to 23 EMA before ultimately recovering at the close and closing well off the lows. And basically, if it does close below the 10 here, it's a very small undercut. So as much as possible during a bull market, wait until the end of the day to make a decision. And obviously, you have to obey your rules and practice good risk management. And this is more for when you have a nice profit cushion of 20, 25%, and you kind of have the ability to wait until the end of the day, because often during a bull market, we'll get strong rallies at the end of the day after some market weakness in the morning. So that's why you want to really, as much as possible, operate on an end of day basis, on a closing basis during the strong uptrends. So to summarize breaking key moving averages, we talked about how to identify trends and what normal action looks like. We talked about normal versus abnormal pullbacks. It also do with the price action and velocity of the move, as well as the volume on the move. Then we talked about identifying character changes, as well as how to basically use different time frame moving averages to slowly exit a position, and basically use breaking key moving averages as a position management technique. So that's it for breaking key moving averages. Thanks for watching. I'll see you guys in future videos.